Cool. So welcome everyone. Just to quickly introduce myself, my name is Devin, and I've been helping to facilitate the Curation Markets call for the past few months now. This is actually our 9th call. I work on a project called Molecule, and we're now based in Switzerland. Our team has done quite a bit of work and research into bonding curves and curation markers over the past year. A little bit of background on the calls. The calls were started initially as a way to enable coordinated collaboration between all of the projects and people working on this tech. And the goal was really to enable faster growth of the new and emerging concepts through this collaboration. This is a community-initiated effort. I'm really just a facilitator here, and these calls wouldn't be possible at all without the global group of curation market enthusiasts that we have, who all work on their own projects in an independent setting or with their companies. The workshops are intended for discussions around curation markets and are intended to encourage participation from you guys as much as possible. Before we get started, we have 3 exciting speakers tonight, by the way, which is usually our layout. Generally, we have 2 speakers, each have 15 minutes to present, and then 5 minutes of questions after the presentations. Tonight we have 3, so the call might be a little bit longer, but I'm really looking forward to the content that we do have coming our way. Please keep yourselves on mute during the presentations, and if you have any questions, you're welcome to ask them via the chat, and we'll get to them as soon as we can after whoever is presenting has finished presenting. Other than that, I think that's pretty much everything. Feel free as well to introduce yourselves via the chat, just like, hi, what's your name, where you're from, and what project you're working on. Might be a cool way to see who we have on this call. It's always nice to connect with you guys. But yeah, that's everything from my side, and I'm going to hand straight over to Jeff, who is our first presenter for tonight, working on the Commons stack.
Awesome. So I guess I will share my screen here. And let me know if you can see this.
Yep, we can see it.
Perfect. Okay, cool. So I have about 10 minutes to run through this.
You have 15 minutes to run through it.
15. Okay, cool. Just a quick, I guess, show of hands or a +1 in the chat. How many people saw my talk at the Token Engineering Global Gathering on Friday of a couple weeks ago or 2 weeks ago? Or, I mean, I'm just wanting to not go over in full detail, but I think some of these things are worth revisiting in this call for anyone who didn't see it. Okay, so I'll go through and I'll spend less time on some of the concepts that I think most people will understand, and we can focus on kind of the functionality of the augmented bonding curve and the usefulness of this tool as a continuous funding mechanism for communities moving forward. So the Commons Stack is a blockchain project that is building tools to scale the commons to reprioritize people and the planet. And a quick intro into why the commons are important. We have some wicked problems that can only be solved together. And a lot of these are around shared resources like our air supply, our forests, and our open source code, to name a few. And these systems basically need social rules around global coordination of managing these resources. And we have several global mechanisms of coordination in markets and in states. However, markets are one-dimensional. They maximize for profit. They optimize out people in the environment. Our governance mechanisms try to impose regulations on those markets, but they're very reactive rather than proactive. And we have a breakdown of global coordination when countries come together to try to resolve climate change. For example, country A won't do anything because country B won't. Country B won't because country A won't. We have a tragedy of the commons, you know, on a global scale, which leads to none of these problems being resolved. So solutions do exist. There's been a lot of research by a great many people. Elinor Ostrom is a great inspiration. And basically commons or open platform cooperatives or digital cooperatives, physical cooperatives, create value-aligned economies that value their people and their local environment. They have non-hierarchical governance. which is much preferable when you're making decisions with subsidiarity, where the community has the power to solve their own problems rather than it having to go up a massive government hierarchy where they make a top-down prescriptive decision that probably doesn't suit most of the communities on the ground. So these initiatives are great, but they exist currently mostly in small communities. And there are examples of cooperative movements scaling. However, when they're operating in a capitalist economic system, they often have to make compromises that give up a lot of the power that really makes these movements effective. So we need to scale this kind of cooperation from small communities to global communities. And we need to do that through basically scaling trust. And we have this technology called the blockchain that can basically act as global trust networks, where we can give communities economies and allow them to encode their values within those economies. And I mean, that might be a little bit weird sounding, but when we go into a few examples, it's kind of interesting how we can unlock these positive feedback loops of capitalism, but geared towards achieving our actual community goals rather than just maximizing profit. So this is essentially what the Commons Stack is trying to do. We are trying to scale the commons by scaling trust with the blockchain. We're building a library of open source blockchain tools that enable purpose-driven communities to raise and allocate funding, to make decisions, and to measure impact. And if you think about it, this is really how we get anything done as humanity on large scale. We either have governments collecting taxes and allocating it to large public works, or we have corporations that are aggregating capital in the stock market and capital markets and allocating that funding to do cool things. But we don't have that tool set for nonprofits and for open organizations dedicated around essentially what we are trying to build with the Commons Stack. So we're a library of interoperable modular components. These components could include governance tools, funding tools, proposal tools, analytics tools, simulation tools, initialization tools, and the list can go on and on. And you can see from some of these that we can incorporate multiple different mechanisms from different projects, from different groups. And we're basically trying to formalize these with a rigorous token engineering foundation so that we can take any of these components off the shelf, combine them into a community contextualized token network, simulate holistically in CAD because all of these will be modeled in CAD. So you just take it off the shelf, you plug them together, you set your parameters to suit your community, and then you can work with your token network rather than just going off of a white paper and then starting to code right away. So that's the long-term vision. Where we're going to start with this is trying to build a minimum viable commons. So we've identified these 4 key components: the augmented bonding curve, providing sustainable funding; the Giveth DApp, providing a proposal and escrow service; conviction voting as a continuous decision-making governance system; and the Commons Analytics dashboard to measure impact. We'll be building each of these components in successive code base iterations, and we're doing a tranche-style raise to raise funds to build each of these components. And as these components are available, they can be forked, customized, and used by any community. For example, the augmented bonding curve could be forked and used by Molotov or Metacartel to provide sustainable funding rather than having to rely on member donations. So all of these will be built using token engineering foundation. So starting with CAD, where we model the system, design, and implement the components. Then all of these components will be available for communities to fork and take their project live. They don't have to use all of the components. They can use the components that are suited to their use case, because we don't believe there's one answer to governance or one answer to funding. It really depends on the community use case. So that's why we think interoperability between these components is so important. And of course, once these initiatives go live, we can collect data and improve our model, building up a more robust understanding of how these systems actually work in a live environment and being able to design for that in future iterations. So we are not asking everybody to start from the mathematical first principles that these components are based on. We're not asking everyone to model these systems, although this will definitely be, this is token engineering level, and there will be, token engineers working on this level. What we want to be able to do is bake this kind of complex system design into these components so that they can just be customized, forked, and used easily without everyone having to go into this mathematics that is absolutely over my head. But this provides kind of an engineer's loop and a new layer of robustness that exists in complex systems and billion-dollar public infrastructure that we build today. So now that we've talked about the high-level common stack system, we're going to zoom into the augmented bonding curve and just examine this component as a potential sustainable is a funny word to define, but a continuous funding mechanism. And we believe this can help mitigate the issue of open source incentivization. And we're excited to experiment about that. So the augmented bonding curve provides sustainable funding for your project or community. And again, what is sustainable? It really depends on the project. I suppose we should probably use the word continuous. It generates continuous funds. This is not a magic money generating machine, but it does have several mechanisms that enable you to incentivize the behavior that you are looking for in the network and make people pay a tax on behavior that you don't want in the networks, and that tax goes to continuously funding the community pool. So an augmented bonding curve has two phases. There's the hatch phase, which is an initialization period of the curve, and there's an open phase where the curve is live to the public. This is like most bonding curves, you can buy and sell and mint and burn. So in the hatch phase, this is basically a community crowdfund to initialize the funding and the collateral pools. So unlike most bonding curves, the augmented bonding curve is split into two pools of value. You have the collateral pool, which is the money that goes out when you burn a token back to the curve, and you have the funding pool, which is allocated to funding community work. Can I get a quick time check? Should I be moving faster? Where are we at?
You are moving quite fast, but you're still good for quite a while. You've only been talking for about 9 minutes.
Cool. Okay, great. So a community comes together and they put funds into the bonding curve. Those funds are split between a collateral pool and a funding pool, and they're issued a token from that bonding curve, just like in every bonding curve. Now, however, this token is a bit different because it's not just worth a claim on the collateral pool, it also gives you governance over the funding pool. So this introduces two separate values for the token, which creates an interplay on the bonding curve, which is really interesting and possibly prevents that run to the exit. So you can see in this diagram here, the sell pressure when the price goes up, people might want to sell, they might want to claim collateral. This pushes people back down. This is the run on the bank, the Ponzi scheme issue with bonding curves. However, when you introduce the governance aspect of the token, you get this opposing buy pressure for people who want governance over the funding pool. So if you have projects that you want to allocate funds for, then you might be interested in purchasing this token because now it has an outsized weight in allocating those funds. So this interplay between these two forces creates volatility in some acceptable range on the curve, and that volatility is turned into continuous funding through the exit tribute. So anytime a community member exits, and this isn't necessarily selling all of their tokens, it could be selling some of their tokens, or maybe they are disagreeing with the direction of the community, they choose to exit their funds. And that exit tribute is basically a pre-agreed upon tax that anybody who belongs to this community believes that some portion of their, if they're profits they're taking, then it's a speculation tax. But everyone is basically agreeing to support this economy when they join. So to quickly recap the augmented bonding curve, we have a circular regenerative bonding curve economy. This isn't, again, a magic money-making machine, but it does have some circular flows. Incoming capital split between a collateral and a funding pool being allocated to proposals, which produces work and value within the economy and perhaps for the outside world. And you have exiting capital that keeps some of this capital flowing within this community. So we've put together a demo of the bonding curve where you can play with some of these initial parameters, the amount split between the collateral pool and the funding pool, the hatch price and the post-hatch price of the token, the exit tribute amount and the vesting half-life. And when you run the simulation, you can see not necessarily predictive, but at least estimations of how this token network may behave. This can be based on agent modeling and all sorts of Monte Carlo analyses and parameter sweeps in CAD-CAD. This demo is just a narrative showcase of what we could do with CAD-CAD. This doesn't have all of the functionality built in. That's quite a data-hungry process. We are going to be working on that in the next couple of weeks. So you can see here the blue line is basically the continuously growing funds in the funding pool. Of course, this is not taking into account that some of these funds will be spent and so on. That would be in a more rigorous simulation. But to start with, this is a neat toy that people can play with, and it shows also the total funds raised by your community in a 52-week time period. So anyway, that's now available at the abcdemo.commonstack.org, so you can jump in there and play around with the augmented bonding curve. There's also a link to the deep dive that Abby Titcombe wrote, and that can give you a lot more information about how the bonding curve works. So now talking about how we can use these sustainable funding mechanisms. Well, we were looking at all these ecosystem funding DAOs. We have Moloch DAO, Metacartel, Trojan DAO. I mean, DAOs are popping up all over the place, and they're coming up with different ways to fund themselves. But we have the proposition that this augmented bonding curve could basically be used by any of these communities. And rather than having members just donate and kind of this ever deflating influence over funds in the pool, that they could use the augmented bonding curve as a way to generate funds for the purpose that they're working on. And there are a few other challenges within ecosystem funding DAOs. We have accountability of funds. Today, basically, when proposals are gone through, the money is sent and we just kind of cross our fingers and hope that it gets done. That's fine at this small scale of community that we're at, but if we're looking to scale these systems, we'll need proposal and escrow services. On-chain voting is an issue all over the space, so we are hoping to address that with conviction voting, or at least address some of those issues. And we have a lack of impact measurement as well. Are the proposals that are actually being passed affecting the change that the community wants to see? And this is basically the Common Stack roadmap, at least near-term roadmap, the 4 components we're building to address each of these 4 issues. And of course, we're hoping that any community would be able to fork and use these components to resolve these issues. So we are also hoping to launch a token engineering commons. We would love to see the token engineering community, the curation markets community, the TCR community, all of these people that are pushing forward on the R&D of all these new concepts. A lot of people are doing it in their spare time, so we would love to see an ecosystem funding DAO come up, co-owned and co-governed by all of these communities, and allocating this sustainable funding provided by the augmented bonding curve to actually fund this work that we're all doing. So we are, as I mentioned before, we broke this out into a tranche style raise. We're going to be raising for each of the components and then synthesizing them together into a minimum viable commons. And I mean, the total cost of the project is probably 7 to 9 million to do everything we want to do and more. And that will be, a really robust, easy to use, forkable, well-documented product. But of course, we understand the nature of the market right now, so we want to be able to raise and ship as much as possible. We just completed an internal raise and open sourced CAD-CAD at the TEG last week, 2 weeks ago. And we are very excited to get moving on a lot of these other components. We've built out our designs, we've tested a lot of our assumptions with simulations, and we're ready to really dive into the R&D and start to build all these components. Another cool thing is we're going to be sending out most of the work, the dev work, to communities within the blockchain space. We don't have a dedicated dev team. We plan on doing request RFPs and RFQs for whatever project and dev team is interested in working on each of these components. So all of the money that, or a lot of the money that is contributed to the Common Stack will be flowing right back out to the community to build these components that we can all use. I won't go too much into the team or advisors, but you can check that out more on our website. And we are basically looking to coalesce a community of people who are interested in forwarding token engineering and the interoperability and the robust design that we think will take this industry to the next level of maturity. And yeah, we open source CAD. Here's some information about the Common Stack if you are interested. And I guess I can stop talking and take some questions.
Perfect. Thank you so much, Jeff, for the great presentation. We do have a couple of questions in the chat already. Cool. Some were just around where to find the demo, and we dropped the links into the chat. So Florian asks, Jeff, are there plans to implement other mechanisms to obtain governance right in this first release or later? Ergo, additionally to owning BC tokens, also levers like rendering a service to the commons.
Yes, definitely. We see tons of different governance mechanisms that could be, on this governance tool shelf. And for each community, and depending on the use case, the size of your community, you will probably want very different governance processes, we would imagine. What is it? BC tokens? Oh, because tokens.
Yeah, because tokens also levers like rendering a service to the commons. Bonding curve.
Oh, bonding curve. Additionally, bonding curve tokens. Yeah. So I mean, there are still in the minimum.
Jeff?
Yeah. Sorry.
Can you hear me?
Yep.
Sorry, it's quite loud here. Apologies for that.
No
so
worries.
specifically, I was wondering about the rights. You were talking about the bonding curve tokens also giving you rights to governance.
Right.
And I was wondering if you guys are considering there being other levers that one could use to give people in the commons governance rights, so not only ownership of value.
For sure. So we really only spoke about the bonding curve in this presentation, and I think it's important to see the cyber-physical commons as a whole, which is this minimum viable commons, because what we are trying to do is create a system that balances labor and capital, and that's a really hard thing to do because they're actually separated by a differential order. So capital is a stock, labor is a flow. So labor has to be integrated over time for it to be on the same order of weight. So what we are doing with this system essentially is by paying all the laborers, all the people that are working within this community in the local token that gives you governance, it actually becomes much more meritocratic, where people who are contributing the most are aggregating this governance right over time. So yes, you may have the plutocratic, a whale comes in and buys a bunch of token and has some governance, but compared to these one-off capital injections, you have this continually accruing governance due to labor. So we're not saying the system is perfect. By no means is this and I don't think there is a perfect system that will balance these perfectly, but it's important that we create the interoperability for community contextualized value. And however a community thinks, this mechanism, there are definitely more mechanisms to come. And this is just basically like the minimum viable mechanism that we see solving the problems of today. There are definitely more problems on the roadmap that could be tackled by future mechanisms, definitely.
Awesome. Yeah, I mean, balancing labor and capital is probably going to be a really interesting challenge down the road.
Right. And it's one of those things that you can't, if you aim for perfection, perfection is the enemy of the good. We just need to improve our systems at this point anyway. We can continue aiming higher and higher, but we believe that doing this in an iterative fashion with the rigor of token engineering is the way to go about that.
Perfect. Sorry guys, I'm gonna have to stop you there. Just in keeping with interest of time. There was one other question on there about one-dimensional economies, but that's something that we can hop back to at the end of the presentation. If there's still discussion time, everyone's welcome to hang on the call as well, like after the last presenter. Thank you so much, Jeff. I really enjoyed the presentation. I'm sure that everyone else did as well. If you guys do have any other questions, you're also still welcome to post them in the chat, and I'm sure Jeff will get back to you. But moving ahead now, we have Paul and Ben from Molecule presenting on the latest developments and also on the alpha, which they're going to tell you more about.
Cool. Devin, thank you so much. Hi, everyone. My name is Paul Kohlhaas, and I'll be presenting with my colleague Ben on Molecule. Wait, I'm just quickly going to share my screen. yeah, having Jeff present beforehand was actually perfect in terms of what we're trying to do. In some ways, can you all see my screen?
Yes.
Yes, we
Okay.
can see the screen.
Awesome. In some ways, like what we're building with Molecule is kind of a commons for basic research and science around drug discovery. So our team has been influenced a lot by the common stack thinking, which has been really, really cool for us. So a big shout out there. Cool. First, kind of a basic overview. What are we trying to build with Molecule, and like what's the fundamental problem in pharma and drug development today? If you look at this little, and I'll keep this very short, if you look at this little diagram on the right, that is basically the funnel that we have today that brings new medicine and therapeutics and drugs to markets. Over the past 30 to 40 years, it's become exponentially more expensive to develop drugs and bring them to market. It costs on average $2.5 billion to take a new medicine or new drug through this entire life cycle until you get FDA approval. It takes 10 to 12 years in the current system. And increasingly, we're ending up with very, very high prices for new therapeutics as kind of big pharma is discovering less and less compounds. Yeah. So what our mission is at Molecule really is to move pharma and biotech from these siloed pipelines to an open R&D marketplace and ecosystem. I'm saying this is a siloed pipeline at the moment. Pharma and biotech are really one of the last industries that take this entire development process and do it themselves. So pharma is very closed source today. Everything happens under NDA. As kind of compounds move from one stage to the next, there's a huge markup, obviously, as new investors come in and the drug moves from one player to another. But the entire data creation process here is closed source, and every company operates by themselves to a certain extent. So what we're trying to build with Molecule is really take this, how the current development works, and bring this into like an open marketplace. And an open marketplace means that on the one side, you have IP and the data around that IP moving into a marketplace. And on the other side, you have patients, universities, investors, pharmaceutical companies that can collaborate on the development of that IP. And this is where we think, or like, sorry, I think someone's not on mute. Okay. I've been following the curation market space ever kind of since Simon started writing about it early on, and thought this was one of the coolest applications that I could think of. It's like, what if we use curation markets to really further the development of medicine in a new open way that would benefit society? So maybe just kind of a brief history of how we kind of came about building this, or like what some of our first thinking was, which was inspired by Billy Rennekamp, who's on this call. Fundamentally, IP is always based on patents and proprietary data. We can take that data in the IP and attach it to a non-fungible token, so an ERC 721. So instead of CryptoKitties, we now attach molecular data or any new invention in general. And then we attach that NFT to a bonding curve by setting the ERC20 bonding curve token as the owner address of the ERC 721. And boom, now we kind of have tradable IP in an open network. And the role that I won't go too much too deep into what bonding curves do, but this concept of refungible tokens, so making a non-fungible fungible again, was first spearheaded by Billy. I'm really looking forward. I think we're slowly seeing more and more experiments where people are saying, "Cool, let's make an NFT fungible again." So that's always been a fundamental part of our stack. How does this relate to how does this relate to basic research and science? We can now use bonding curves as prediction markets. One of the problems in this industry here is that currently market participants, if they own the entire piece of the pie, so to speak, they don't have any incentive to release negative research data. And what bonding curves in this sense do is, because different participants can trade up and down the curve, we now have incentives to release positive research data, which is likely to increase the price. And as well, we release negative research data, which is likely to decrease the price. So market participants have incentives to reveal data in the same way that prediction markets do this. They have an incentive to analyze the data and place their bets accordingly. We think this kind of thinking and applying this to the sciences can have a much bigger long-term impact, specifically because it can address some of the current challenges that we have in science around reproducibility of data. Yeah. The cool thing for us is if we also attach real assets to these markets now, so they're not just prediction markets, you're actually trading shares of IP. what are the implications here for things like insider trading? If I'm now trading on scientific data that anyone can freely produce. So this is kind of just as a brief overview and kind of where the journey, our journey has taken us. So I'm really excited. We've previously announced this at the Token Engineering Global Summit as well, but I'm really excited to tell you more about the alpha that we're launching in early October this year. So our alpha is called Molecule Catalyst, and our goal for this alpha is to crowdfund 3 and potentially more projects in the area of basic research. So if you think back to that diagram I showed you earlier, what we're now focusing on is that first kind of funnel that generates new potential insights on new potential treatments. And Catalyst, in a sense, is an experiment in bonding curves and incentive design around how we can fund basic research. The target areas that we're going to go for in this launch are in rare and neglected diseases, in biogerontology and aging research, and in psychedelic studies. The reason why we've chosen those areas are one, because we feel they have a good appeal for the crypto community, but also because those are actually areas where it's very hard to get funding in basic research for, because they're not as commercially interesting, or they're still fringy topics that larger pharmaceutical companies don't have as much interest in. Briefly about the properties, but I'll dive into the architecture of the alpha. So these are all public bonded markets on mainnet Ethereum. All markets will be funded via DAI, which also makes them somewhat interoperable with the broader DeFi ecosystem. And each project has a funding goal between $20,000 to $100,000. So we also chose this chose to start off with this area because the funding, we can make a big impact on a small set of research that can then also funnel on and actually start growing through this drug development cycle. Cool. So I want to give you some info, a little bit about the projects to actually make this much more concrete. So one, I can't reveal the institutions yet that we're working with, but there were 3 leading drug development labs at leading universities, 2 in the US, 1 in the US, 1 in Canada, and 1 in Denmark. The first project is a high-impact clinical trial to study the effects of microdosing psilocybin. And it's a double-blind study with real people. So it's a real clinical trial that is testing this. The second one is, we can reveal this because it's already been signed. It's with the University of Copenhagen and their Biogerontology Lab, which is on discovering interventions linked to healthy aging and longer lifespan. So they're basically testing a range of molecules and the effect that has on human cell metabolism and lifespan, which could ultimately lead to in both cases, to really promising new drugs being developed. So how does this tie together with Catalyst? So these are 2 examples of research projects that we'll be launching on the system. We're really excited. I'm personally really excited about this. It's kind of bringing a real life asset and a real life use case into the Ethereum space, and kind of leveraging the power that we can build with these markets. So kind of want to give you a basic overview of what the architecture for the alpha looks like. And then Ben is going to go a lot deeper into what it looks like and the different incentive schemes that we're building behind it. So this is a kind of a high-level diagram. So on the one side, you have funders that stake DAI into individual campaigns to contribute to the campaigns. In a very similar way that the common stack has both a collateral pool and a funding pool, our system works in the same way. So there's a funding tax that gets taken out of each contribution that goes to the researcher. Once a funding campaign is filled up, either it's an individual project milestone that has been met. So let's say, for example, $25,000 to be able to perform the first state of the study. Those project results are then released on a continuous basis. And in return, the funders receive a stake in the project. Now, a little bit about the legal parts around this. So the participants are essentially gambling on the success of a donation campaign. So all of these contributions into a market and to a project are considered donations. So it's like a collective grant that is coming together to fund a specific researcher. Every funder and contributor stands to win back a part of their contribution and potentially also make a return on their contribution, depending at what stage they entered the bonding curve. So obviously, early backers actually stand to make a return if the campaign goes successful or even overshoots its goal. This obviously also depends on their own efforts. So the funders now have an incentive to promote this research project to other people in order to get more contribution in. The tokens itself represent the value of the curve collateral. So the tokens that I get now for contributing to the project are my stake in the overall collateral pool. Then depending on the project, they're also just a memento of the project. So the researcher can later on decide, hey guys, thank you so much for supporting me. I'm going to give you X or Y. It may also represent governance rights in the project data that is coming out. Ideally, all of the project data is being open source though. And for us, the most exciting part of this is that the tokens may also represent a future rights to the IP that is coming out of it. Now, the problem is with IP coming out of these projects, if I go back, we're in this basic research space, and there is no IP yet that is created about these projects. However, and there is no claim that these tokens give me on the IP. However, if very promising IP comes out of a research project like this, and here with the University of Copenhagen, we're really looking at specific models that could result from this, then the lab could decide to allocate a portion of the IP to the token holders. However, this would be almost on a voluntary basis. And so that's some of the challenges that we've been dealing with as well, is like, how do you find a mix between voluntary donations, but also being able to stand to own a part of what could potentially come out of this without having any rights to it. Yeah, and maybe on this note as well, so this is essentially using the same model as Kickstarter is using, but with a slight twist on it. So from a legal perspective, and the advantage of that is for us is like all of these markets can be fully open. There is no KYC that participants need to go through. And that was one big goal for us, to really being able to push something out into the ecosystem that was open, that people could interact with very directly. Cool. I want to hand it over to Ben at this point.
Cool. Thanks, Paul. Let me just get my screen up for all of you. Okay, can you see the slides?
Yep, we got you.
Great. Okay, so I'm going to take you through some of the demo screens from the Molecule Catalyst web app, and then briefly go over some of the CAD simulations that we've done ourselves. So I'm glad Jeff took us over a background of CAD and what you can achieve with it. So the first step for the project creator or the researcher is to design their campaign, set up specific phases where they would like to get a predefined amount of funding over a time period, much like you would do with Kickstarter. So you have the options of either making the duration the sort of hard limit, where once you reach the end of that duration, the funding is redistributed fairly, or and once you reach the funding goal, the project who's created this campaign will then be able to use those funds to fund further research. Once the project is created, then there's a basic sort of discover page where a user will be able to go and investigate the projects on the system and see what research has been produced, what funding they're looking for, how they can contribute, and get a better idea of how successful a project is currently. So here's an example where we've got a drug that is being developed for health and lifespan extension. So you would have a basic overview and abstract. You would be able to see the phases that were described earlier and the goals to complete those phases. You'd also then be able to see for a particular project what the funding status is, and you could enter in, for example, here 3 phases with different funding goals over different periods. The bonding curve market is a basic linear bonding curve with a few twists, which we'll show you later in the CAD simulations. But basically, the incentive pool that you entering into will grow or decrease in value over time, depending on how popular or successful the campaign is. And you'll be able to get a return on the portion of the contribution going into the incentive pool. So much like with the augmented bonding curve, you would have two separate pools, one for the funding of the project and the other for basic trading behavior and governance rights over maybe potential production of IP. Okay, and yeah, the idea is that the research results will be open source. There might be variations of this in future, but for our first version, the research results are published so that the public can see them, and potential rights over this data could be attached to token ownership, for example. So we also looked at incentive design and wanted to look at the two extremes of funder archetypes. So, for example, you've got a funder whose primary goal is to receive a return on investment on their contribution, less the contribution tax, and they would be betting on the success of the project's campaign and its tokens, the tokens representing not only something that could be burned for collateral DAI, but also for future potential or IP. And depending what archetype of investor you are, you might decide to choose one over the other, or where your primary goal is altruistic support with certain other benefits that could be attached, so over a pure donation. So it's a big challenge balancing these incentives. You can't get anything for free. Like Jeff said, it's not a money-making machine, but the aim is to implement as balanced a system as possible where both funder archetypes are incentivized to participate. And traditionally in a donation campaign, you lack any other incentive other than being a decent human being. Okay, so looking at CAD, which Jeff took you over earlier, we've got a few system parameters that we've been testing, which are primarily bonding curve parameter design, how the system behaves under, pump and dump behavior, how do you avoid those issues, and returns and participation incentives for the users, as shown earlier, and effects of different curve taxation. So maybe continuous curve taxation over a time period, varying curve taxation to swing the favor from early investors back to later investors, things like that. So one thing we noticed, which Jeff touched on briefly, was with CAD, the idea of implementing rigorous mathematical simulations. It's not always possible. We don't all have that experience, or we don't necessarily know the parameters of the system entirely. Maybe it's too complex to model or model accurately. So instead, you can look at best and worst case scenarios. You can treat it as a black box system and see how the system varies in accordance to changes in parameter or sensitivity to a parameter. So we've looked at, for example, a distribution heat map of return on investment or value for a user. So depending on where a user buys in versus where they sell out, you can see that for a basic linear curve, starting at the origin, you have some users receiving 1,200% return on investment, others receiving nothing or negative, which is this purple color here. If you shift the linear bonding curve up the y-axis, which is essentially just a hard-coded hatch price, like Jeff mentioned for the augmented bonding curve, we've chosen a hard-coded hatch price of approximately 0.5 DAI per token, which results in a much fairer distribution where users are receiving between 0 or negative to 12% return. And we find that approximately 30% of users will make a return on investment for this simplistic system simulation. And if you then further distribute the collateral on a flat 100% collateralized curve, you then get an even better distribution where more people are, it's difficult to see in this diagram, but the numbers show that more people will receive a return on investment. Okay, and also, once again, rather than doing like too deep mathematical design, we took two basic funder behaviors, which is buy and hold or seek a percentage return on investment, and modeled those. I won't go too much into that. Yeah, and there's a lot of parallels with the augmented bonding curve, but the augmented bonding curve goes well and beyond what we're doing at the moment, and maybe we'll even fork it in future. So yeah, thank you for listening to our presentation. If you've got any questions or want to join our social groups, here are all the details.
Yeah, guys, I just want to say as well, if anyone's keen to get involved, we're doing user testing at the moment, so we'd love your feedback. Easiest way is to just join our Telegram group or ping us on, ping us on Telegram. We're also opening up a Discord. Just ask for the invite for that on Telegram. It's still kind of closed. And we'd love for any of you to become early backers, obviously, for these projects when they go live. So get your die ready. And yeah, happy to take any questions still.
We are running a little bit behind on time, so we can take maybe one question. If anyone has anything, you're welcome to unmute yourself and ask out.
I can also answer questions in the chat if that speeds things up.
Sure.
Yeah.
We can do that. And then if you guys do have any questions as well, if you think of anything afterwards, please just drop them into the chat and we can get to them at the end of the presentation. So we have our final presenter coming up now, and really looking forward to this one. I'd like to introduce you guys to Elad.
Hi, everyone. I'm just...
No problem. Take your time.
Hi, everyone. Just getting this set up. Just a second. Okay, can everyone see my screen?
Yes, we can see it.
Perfect. So hi, I'm Elad Verbin, and I'll be speaking about the mathematics of bonding curves. So thankfully, there's been a bunch of discussion of bonding curves. So I'll give a very, very short introduction. Here's what we're going to talk about. So we're going to talk about a little bit about bonding curves, and then we're going to talk about the mathematical finance of bonding curves. So very theoretical discussion. I try to keep it as math-light as possible, but we're going to talk about why we do the mathematics of bonding curves and what are they. And we're going to ask a lot of open questions. This comes from, my dumb questions about what these beasts allow that went unanswered for enough time that I decided to write them down and then started somehow answering them a little bit. So we're going to ask about whether bonding curves are good market mechanisms, and I'll define what I mean by good, but basically it means that they behave like we expect the market mechanism to behave. And then we're going to ask, are they efficient market mechanisms, which is a very different thing than good. Specifically, this will be a quantitative analysis of bonding curves. And I'd like to say already that what we want from a market is that a very small amount of locked-in capital can represent a very large amount of value. And we're going to ask, do bonding curves allow us to represent a large amount of value by a small amount of capital? And finally, are there other good market mechanisms out there? So to start, a little bit about me. So I am a computer scientist by training, did some time at doing machine learning for a hedge fund. So that's the extent of my economic understanding. Specifically, I'm guaranteed not to be an economist, right? And these are all questions that might be answered in the literature, and I'm going to show a bunch of guesses, educated guesses basically, but this is inviting you for further research, and I love these questions, and please talk to me with any ideas you may have. There's a corresponding Google Doc that I am going to share now in the chat, and is also linked from the presentation. And the Google Doc goes into more detail about the mathematics that I am not going to, in consideration to to not losing everyone, I'm not going to get into. So all of the math, a lot of the math is done in the document that I just shared, and yeah. Okay, so, and in my day job, I am, in my day job, I am an investor. I'm a researcher, a computer science researcher in a VC firm called Lunar Ventures, and we invest in very early stage computer science-based ventures, particularly around blockchain and decentralized applications, but not just. So if you have a very early stage project, and please talk to me. We're very interested in token economics and in other topics like Web3 and others. Okay, so very quick intro to bonding curves. In general, bonding curves are this market mechanism that sells you. There's a smart contract, and it mints tokens and sells them to you, or it buys them from you and burns them. And the important thing is that the current price is just one thing. It's the function of the current supply, right? So the current supply, the current number of tokens outstanding is x0, 0, and the price of the next token is going to be f of x0, where f is a function that you can choose. That's one of the design parameter of the bonding curve. Okay, and it's basically an automated market maker. So while in a traditional stock market or anything like this, people with stock buy and propose to sell them, and other people who want them propose to buy them, and there's a matching going on using an order book. Here, there's no matching going on. There's only one entity, one centralized entity, which is the smart contract. And some people come and want to sell, and some people come and want to buy, and their needs are always met, which is the wonderful thing about bonding curves, which is there's no double incidence of needs, right? Each person can come completely asynchronously and sell or buy as they please. So that's a really great thing about bonding curves. And in this talk, we'll study some things that we have to trade away. Now, for this particular talk, since I'm going to do some mathematics, there's a few properties that make this mathematics easier. So we are going to assume two assumptions. One is that this bonding curve represents fractional ownership in an underlying asset. This asset can be a bundle of cryptocurrency, or a company, or an IP, right? Paul said representing IP using tokens is very complicated legally, but for this talk, I'm going to assume that we are representing a fraction of a company. And all of the tokens together represent the entirety of this company, and having one token represents the fractional ownership in this company. And the other thing is I'm going to assume that our bonding curves are continuous, which means you can buy fractions of a token. You don't have to buy in discrete tokens, and that's just going to make our math easier. So while in traditional bonding curves, the next token is going to cost f of x0, in continuous bonding curves, you buy some sort of epsilon here if you see the purple line, and what you're going to pay is the integral from x0 to x1 of f of x, right? So you're going to basically pay the area under the curve of the amount of tokens you want to buy. It's kind of the same, but a bit easier to work with. Okay, so let's talk about the most classic market mechanism of them all, order books. Order books allow you to represent a large amount of value with a small amount of locked-in capital. They allow trading in any security and, in fact, in any fungible asset, right? The only assumption is that you buy and sell units of something. We don't care what it is. It's a bond, it's a stock, it's an option, it's whatever it is. If you can represent it in a number, then order books allow matching of buyers and sellers, right? And the important properties of this, as we said, it allows very large amount of leverage, and it's a single source of truth, meaning you just come and you trade, you throw your bid or ask into the market, and it hopefully just clears because there's hopefully a bunch of market makers out there hoping to take your trade. Okay. Now, what we're going to study is not order books, but rather bonding curves, and we're going to study their theoretical behavior, right? So a lot of the things I'm going to say are not going to be true in empirical in the empirical behavior. But we're going to study the most extreme situations that bonding curves or order books can find themselves in, because that's kind of going to tell us stuff about these mechanisms, about the inherent truth of these mechanisms, and we're going to mathematically prove these properties. Okay, so chapter 1, the first thing that we're studying is, are bonding curves a good market mechanism? And what do we mean by good? Well, let's see. So suppose Alice wants to sell some units, and Bob wants to buy some units. And remember, these units represent fractional ownership in an underlying asset, such as a company. What happens with order books? Alice and Bob go to an exchange and list their desires, and a match is made. Okay, that's very simple. What happens with bonding curves? We don't know. Clearly, Alice can sell to the contract, and Bob can buy from the contract. But maybe they can do better. Maybe Alice can do some weird thing where she goes to a side market and says, I want to sell, and she's going to get a better price. This is called over-the-counter trading, and it actually even occurs in traditional assets such as stocks and bonds. So if I have a huge amount of stock, Apple stock, for example, I'm often going to go directly to the stock market and put the sell order, because it's going to create weird fluctuations. Because remember that a large amount of value was represented by a small amount of locked-in capital. If my holding represents a large fraction of this locked-in capital, this is going to make waves and change the price while I am selling, because the depth of the market is not going to be able to match with my sell. So in reality, even if in traditional order books, if I go and try to sell a very large amount, I'm going to try to do it over the counter, okay? So we know that in traditional markets, over-the-counter trades occur. And in bonding curves, as when I asked this question, as many people mentioned, yes, this is also true for bonding curves. If I try to sell a large amount, suppose that I am Alice. So if I sell all of these units, I'm going to only get the red amount, right, the area under the curve. But if Bob is willing to buy the same amount, he's going to pay the blue. So you see there's a discrepancy. Bob is going to pay a higher price than I am selling at. So the logical thing is for me to come and talk to Bob and find some price in the middle, right? So this is definitely going to happen. Now, the actual question that we should ask to make sure that bonding curves are a good market mechanism is, suppose we make tiny bets, tiny trades. Are over-the-counter trades still going to happen? And luckily, there's a mathematical answer to this, and I can tell you at least a sketch of it, which is that no, over-the-counter trades will not happen. And in fact, if people only want to trade small amounts, they will just do this with the contract. And that's a really good property, because it means all of the information required for the market is held inside of the contract, and all of us should, by default, just go and trade with the contract, unless we have to do something weird like dump 10% of the market cap. And that's really great. So how do you prove such a thing? Well, here's the sketch. And again, this is not peer-reviewed. So, if I got something wrong, there's some assumptions underlying, and if I got something wrong, please tell me. This is out more detail in the document I linked to, but the sketch is as follows. Suppose Alice wants to sell epsilon units, right, a tiny amount that is represented here in the red, and Bob wants to buy. Now, Alice can just sell to the contract at the red price, and Bob can buy from the contract at the blue price. And as you can see, if these strips become narrower and narrower, the areas under them become almost equal, to the extent that the blue price and the red price, basically you can assume that they're equal if the amount is tiny. So I claim that in this case, Alice and Bob should just buy and sell from the contract directly. Why? Because no one, including Bob, will buy from Alice at a higher price, because they can just buy from the contract at the blue price. And no one will sell to Bob at a lower price, because they can just sell to the contract at the red price. So if everyone is rational and latency is 0, the only prices that make sense are between the red price and the blue price that are essentially equal. So they might as well trade with the contract directly. Right? If you're not happy about these red and blue being slightly unequal, here's a better graph for you. Basically, there's only one reasonable price to buy or sell at. So this is a very basic lemma, let's say, about bonding curves that say everyone should just buy and sell at the correct price. directly from the contract. This is really nice. Now, if the quantity is large, then as we said, there's some gap here between the red price and the blue price, and they should do over-the-counter negotiations. And the over-the-counter negotiations should land them somewhere between the red area and the blue area. In reality, I should say, right, we're studying theory. In reality, over-the-counter trades will happen because taxation considerations make, right, they're called over-the-counter, but really they should be called under-the-counter, because the point is that you sometimes are able to avoid taxation, you're able to avoid other entities seeing what you've done. In bonding curves, there are also going to be latency considerations. So over-the-counter trades will occur, but this property that they're not necessary for small trades in theory is going to be able to allow us to do other analysis. What kind of other analysis? So let's get back to our main question. Are bonding curves good market mechanisms? Okay, so let's go back to order books. Another good property that they have is the price discovery property. What does this mean? This means that if most people are rational and have some way to estimate the correct value of the underlying asset, and suppose that they mostly agree on what the underlying value is, then the price will converge towards this underlying value. And by price, I mean the market cap. So in other words, the token price, or stock price as it may be, times the number of tokens is basically going to end up being the underlying value. So think of it in how it works in the stock market. Suppose that you have a bunch of your hedge fund and you have a bunch of analysts working for you, and they do some fancy, price analysis or DCF analysis, discounted cash flow analysis of Apple's future returns and so on. They will end up at a guess price. Let's say their guess is $1 trillion. Then if right now the market cap is less than $1 trillion, then each token is, or stock, is too cheap. So someone that has liquidity will come and buy this stock until the price ends up being the correct price that people agree on, and vice versa if the price is overvalued. This is also called the efficient market hypothesis. It doesn't work in general because no one is rational and no one can agree on the price and so on. But at least in theory, you can formulate conditions under which this works. Now, the question we should be asking ourselves if we really love bonding curves and want them to be used in practice is, do bonding curves also have this property? And it's really not obvious. So this is a question I don't know how to answer, and I would love someone's help with. Do they have the price discovery property? My guess is that they do, meaning that if most of us mostly agree on the price of the underlying, then the price of the token will change, or let's say it like this. Tokens will be bought and sold until this equation holds, that the token price times the number of tokens outstanding is equal to V. Bonding curves are a bit different than stock, because stock is rarely minted, and tokens are always minted. So what I'm saying here is that tokens will be either sold or bought until this equation holds. And that's what it means that the price discovery property holds. My guess is that it does. One thing that's interesting to study is what is the process by which they converge. Okay, what's the dynamics of reaching this? By the way, maybe to say one more thing, actually, I'll get back to it later. So there's many other questions around, are bonding curves good market mechanisms, and do they satisfy the properties that we have come to expect from order books? Okay, so another set of questions is, are they an efficient market mechanism? This is an entirely different set of questions. So for that, let's talk about what's efficient about order books. I'm going to claim that order books are an extremely efficient market mechanism. So for example, the Apple market cap is currently around $1 trillion. That's the amount of value that we as a society have decided that Apple is likely worth. Now, Apple doesn't have $1 trillion in its bank account, and really, if you asked Apple to produce $1 trillion right now, they wouldn't be able to. So what does this value mean? It means that we as a society have agreed that if we sell small amounts and buy small amounts of the fractional ownership of Apple, then the right price for them is determined by this 1 trillion. And in theory, this should be represented in the fact that over time, we are going to get dividends and so on that are, whose fractional, whose discounted value is equal to 1 trillion. This is for a long time not the case anymore. So markets have gone away from talking about realized cash and dividends, but still we are able to evaluate the price or the value of a company. But let's avoid talking about this crazy amount of money, 1 trillion. How much money is actually locked in, right? How much money do people actually put in to end up at the 1 trillion market cap? And the answer is typically something like 20 billion, right? I don't know the exact answer for Apple, but in general, the stock market creates a leverage of around 1 to 40, 1 to 50, depends on locked-in money. Let's do a thought experiment to kind of appreciate this fact. Suppose that tomorrow morning, the CEO of Apple comes and says, we have invented the best flying self-driving cars. And he comes and he says this at 10 a.m. What happens? The stock market is going to explode, and the stock will trade at, let's say, twice the price as they did at 9 a.m. Okay? It's going to be pandemonium. So the market cap has multiplied to $2 trillion. But if you think about the money that is locked in, the money that's locked in has not changed by much. It might change throughout the day. But at 10:01 a.m., the stock is already trading at a market cap of $2 trillion, but the amount of money that's locked in is still 20 billion, right? So the leverage has increased by a factor of 2. And in reality, what order books allow us is to have an infinity to 1 leverage. So even $1 can represent $1 trillion in the stock market. Now, this beast of leverage has many names: leverage, reserve ratio. Berninsky, when he studies Bitcoin, calls it the fiat amplifier. Banker calls it the connector weight. But in the end, you always talk about the same thing, which is that a very small amount of locked-in money represents a very large amount of value. Now, let's talk about the reserve ratio of bonding curves. How do we define it? Well, you can define it in the same way. Look at the locked-in capital. It's actually easier to define it with the bonding curve, and it's easier to analyze it, which is one of the cool things. So if you define the locked-in capital, the brown area, as C for capital, and the market cap, which is the green area, the green rectangle, for MC, right? Why is the green area the market capital? Because it's the number of tokens multiplied by the price of a single token, right? Then the reserve ratio should be MC over C, meaning how much does $1 brown dollar, how many green dollars does $1 represent, right? And the nice thing is, as we analyze the reserve ratio of bonding curves, we can actually find the formula for it, because the amount of both C and MC depend on each other in a deterministic way. So we can define a function of C, of the brown area, that is equal to MC divided by C, right? This is the reserve ratio of the bonding curve. It increases typically, or might increase, as C increases. And what we want it is to be very large, because we like large reserve ratio. We don't like locking in capital so that it doesn't do anything, right? And the important thing is that it's a function of the brown, of the brown area, right? Now, the question we care about is, if we lock $1 billion in the bonding curve, how much underlying value can we represent? And the intuition is that the faster growing the bonding curve is, the more the reserve ratio we get. Okay, so for example, I won't show you the way to calculate this, but it has to do, basically you take the derivative of the function f that defines the bonding curve, and you divide it by the integral. This is all in the Google Doc. But for example, if you take the bonding curve, which is x to the 4, then it turns out that the reserve ratio is exactly 3. So for every $1 locked-in dollar, you represent $3 of value, and that's it. You can't have higher than this, which is actually pretty unsatisfying by stock market standards, which are like 50 to 1, right? Now, one thing that I want to claim before we continue is that when analyzing bonding curves, people usually look at this graph, which on the top, which is like x to the 3 or whatever it is. But it's actually, I'm going to claim that it's a very misleading graph to look at, and it's very not useful, because it's a function of the number of outstanding tokens but the ratio of or token actually decreases with time. So what you should really, there's some noise. Okay, so what you should really be looking at is this, is other graphs, and in particular, I really like this graph, which is C versus MC, right? The locked capital versus the leverage ratio. And in this case, for the function x to the 4, the leverage ratio is always 3, which is kind of unappetizing, let's say. Okay, so question 3 is, how high can the reserve ratio be? And for older books, as we said, the answer is infinite. And for bonding curves, the answer is also infinite, right? Why is it infinite? Because you can always take the bonding curve, which is 0, 0, 0, until it jumps to 1 at some point. And just after it jumps to 1, the reserve ratio is as high as you want. But this is a very unsatisfying answer because it's only at one particular time in the bonding curve's life that it's unbounded. So if you basically, so the right question to ask, and again, this is fleshed out in the document, is how high can the reserve ratio be if you want it to be high all across, right? If you want the function to just be increasing. And the answer is that the function that maximizes the growth rate of the reserve ratio is actually one of these crazy functions, right? This fits our intuition that if the function grows very fast, then the reserve ratio is as large as it can be. And for example, when the bonding curve is exponential, which is a really high growing bonding curve, the price of every token is much higher, multiplicatively higher than the one before that, then you get a reserve ratio of ln C, which to get to 50, you're going to have market cap, which is very, very, very large. And I'm going to claim, I think I have a proof for this, but someone with actual mathematical chops should confirm it, that this is almost the largest that it can be, that the largest that the ratio can be is ln C times ln C times ln C, and so on. This kind of multiplicative function converges, and that's the highest you can go with a very, very fast-growing bonding curve function. Okay, so what have we learned? We learned that the leverage ratio actually grows quite slowly, like ln C or maybe ln C, something like this. And that's the fastest you can go, and that you pay a lot. Why do you pay a lot for this? Because you pay in stability. When the function is so quick to grow, then it's a very bad bonding curve function because it's very unstable. Okay, so the question 4 is, how should we measure stability, and how should we measure this or formalize this claim that the bonding curves with very high reserve ratio have a very bad stability? So here's my suggestion, and again, this is fleshed out in more detail. The suggestion to measuring stability is when someone owns 10% of the locked-in capital and sells all of it at one go, how much does the price drop? And the claim is that the higher the reserve ratio, the worse the stability. So there's some underlying trade-off here. Okay, so to sum up, what have we learned? Bonding curves offer less leverage, at least in theory, than order books. But they offer more stability. Not that order books have terrible stability, because it can be that $1 represents $1 trillion, and if that person sold the ownership, it could now represent $1. Intuitively, what this means is that order books have an ability to blow up bubbles infinitely, and bonding curves do not. This is, I think, the intuition that all of us share. Now, the business question that I want to offer to you that are really passionate about implementing bonding curves is, why would any CEO decide to tokenize their asset on a bonding curve? If you're the CEO, you want a small amount of capital to represent a large amount of value. And bonding curves either don't let you do that, or if they do let you do that, because you use the crazy high-growing, fast-growing bonding curve, then they're not stable, then you're stuck with stability as bad as an order book. So, so that's a question for further thought. How do we advocate for bonding curves if really they either have bad leverage or bad stability? The third kind of idea that I want to throw out there, and I'm close to finishing, is are there other good market mechanisms? So, so far we've seen double-sided order books. we've seen bonding curves with various parameters. Like order books basically don't have parameters, barely. Bonding curves have parameters. Someone suggested to look at Uniswap as a possible market mechanism. I haven't done that yet. And the question is there anything else, right? What's the design space for good bonding curves? For good market mechanisms. Now, maybe I should say, what's a market mechanism, right? The market mechanism, in general, is some sort of mechanism that allows people who want to sell and people who want to buy to come and perform these trades, so that in the end, people are able to fractionally own parts of a collateralized asset and perform trades in it at their leisure, right, at their time of choice. And any such thing, especially that has the good properties that we discussed, which is price discovery and no OTC, are good market mechanisms. Now, my general mathematical intuition is that if we have two of them, right, double-sided order books and bonding curves, you have many more. And I think what we should do is explore this space and try to learn about other market mechanisms that maybe would be also very interesting. So that's it for me. I think the next steps are, if you're interested in diving more deeply into the math, to look at the draft document, which is here, and you can email me to ask for it, and I'll actually post it in the document of the workshop. Think about these open questions, figure out the math, define properties of them, figure out how to think about bonding curves, go beyond just looking at the graph and trying to guess things, but actually study things in a rigorous mathematical way at their extremes. And I think this will be very profitable for everyone. Please contact me about all of this. I'm very happy to chat about it. Thank you.
Amazing. Thank you so much for your presentation and for your time. There was quite a lot of chat happening in the conversation, so I don't know if you want to take a second to quickly read through that. But Ben has a question and asks, he's asked if you could post the slides and the documents and the links in the chat. Also, to everyone that's on the call, there is a working document for the TCR calls that are run by Emily, and there's after those, then there's also the Curation Markets calls, where I post just about the speakers and any links that are associated with all of the speakers, and the recording also goes into that document a little bit later. If you have any summaries, or if you'd like to take any notes, you can also drop it in there. Are there any questions for Elad while we have him on the call? Or any thoughts?
I'm curious to dig into that math a bit more, perhaps with you, Elad, just to understand the reasons for those formulas. And I'm curious if you've gotten to connect with Zargam yet about those formulas, or have you not? I guess he's been at Burning Man actually, so probably not.
I haven't. We were a near miss several times on this. This is kind of work from the last few weeks, so we tried to intersect in Berlin, but no, Zargam has not raised his eyes on this, and I'm looking forward to to what he's going to say about it, actually.
Cool, yeah, me too.
Yeah, Elad, I really enjoyed the way you presented the theorems, and you made the sort of proofs really accessible to all of us. So it's a great presentation.
My pleasure, thank you.
It was very cool to see the leverage ratios, and I haven't seen that laid out quite in that way before, but it is something Griff has been calling it like the market cap illusion, and really the power that is, or the financial power that creating an asset like a bonding curve allows either for-profits or non-profits to do. It's really impressive. So it's cool to see it laid out that way. Thanks for that.
Sure thing. I think maybe if there's one thing I'd love to people to take away from this, is that I think a lot of them, when I see analysis of bonding curves, a lot of the time it concentrates on the graph itself of the function of the price per outstanding tokens, and I think that's often really misleading. And so I'm kind of playing around a lot with other ways to other graphs that could be drawn about bonding curves that don't have this misleading property. This is the one I like the most right now, the locked-in capital to the leverage ratio. But I think that there are a lot of interesting graphs to draw that kind of show in a more focused way what bonding curves actually afford you kind of what market behavior they actually afford you versus yeah.
Yeah, sure. I totally agree. It's very non-intuitive to look at certain graphs that it looks like they might be telling you something, but actually and when you have the supply and price and supply, which is the common curve, actually every delta S that you move up that curve, because it's an exponential in this case, the delta S actually gets smaller and smaller at a really quick rate. So the intuitive mind that says, oh, this increases quadratically, it actually increases quadratically at an ever decreasing rate. So it's a very non-intuitive way to look at it. I agree, and I think it'll be interesting to compile sort of these bonding curve dashboards and being able to look at the useful information and how that relates to a specific community.
Yeah, absolutely. Yeah, in general, I think that the graph, looking at the normal bonding curve graph, allows you to form intuitions, but is harder to form quantitative estimates. And yeah.
Yeah, Elad, I want to say as well, thank you, really cool presentation. And I agree that I think the current ways that people are displaying and thinking about bonding curves is very misleading. I think that's just where we lose a lot of, first of all, I think we lose a lot of people who are like, this sounds interesting. And then they're like, wait, I don't understand it. What is a supply curve? Because I mean, it's just basic economics, but yeah, I think having better ways to showcase that. I mean, I hope that once we have more and more bonding curves lives, that a lot of them might not even look that different to what a traditional market chart looks like. But for some reason, because we don't have that historical data, we always revert back to like this, this thing which is very misleading. And then I think, yeah, I think over the long run, probably we will move away from displaying bonding curves like this into much more, probably in the back end, much more complex designs that might take into consideration much more things like you described, like what is the leverage ratio to the locked capital, and that leverage ratio can start increasing as the more mature a market becomes, which then actually starts mirroring existing like stock market ratios at some stage. Yeah, just as a side comment.
Exactly. There's this, I think the idea that you pioneered or at least you implement that says at some point the bonding curve gets dissolved and becomes just tradable, freely traded in the open market. In theory, I'd love to come to a place where we are able to design a market mechanism that either does this shift gradually or maybe even does away with it altogether, saying we are able to understand bonding curves well enough that we can trust them for a large amount, for a large amount of market capital.
Okay, I think I'm gonna cap the call here. And I just wanted to say a huge thank you again to all of our speakers that joined us today and to all of our attendees. Also props to all of you keeping the chat so interesting during this presentation. I think it's been vibing in the chat, which has been really cool to see. All of the links and documents are all available on the TCR working doc. And if you guys would like to reach out, please just drop me an email. If any of you would like to present on future calls, also just drop me an email. My email is devin@molecule.to. And you can also just feel free to reach out via Telegram. If you have any suggestions for improvement, that would be great too. But yeah, other than that, enjoy the rest of your week, everyone.
Cheers, Devin.
Thank you very much, everyone.
Thanks, everybody.
Thanks so much, everyone. Thanks, Devin, for organizing.
Devin, before you close the chat,
Okay.
the call, do you mind just copying the Zoom group chat? There's an option there to save the chat.